Welcome to Asset Zenith, your trusted source for financial knowledge, investing strategies, and the tools to help you build lasting wealth. Today, we're diving into a question every investor should ask themselves. What is your risk tolerance, and how can it help you choose the right investment strategy? This isn't just a financial concept, it's personal, and it might just change how you invest forever. So let's begin. Imagine this. You're sipping your morning coffee when a headline flashes across your screen. Markets crash overnight. Investors panic. Your heart skips a beat. You check your portfolio, and it's down. Way down. Now ask yourself, what do you do? Do you sell everything? Do you stay calm and wait it out? Or do you see it as a buying opportunity? Your answer reveals something powerful. Your risk tolerance. Risk tolerance is your ability and your willingness to handle the ups and downs of investing. It's not just about numbers. It's about how you feel when things don't go as planned. Let me tell you about two friends, James and Olivia. Both started investing in their 30s. James loved the thrill. He chased crypto, hot stocks, anything that promised fast returns. Olivia was steady. She preferred slow, consistent growth. She read, researched, and stayed cautious. At first, James saw big gains. He bragged about doubling his money. Olivia's returns were smaller, but she felt secure. Then came the downturn. Markets fell. Fast. James panicked. He sold at a huge loss. Olivia? She stayed calm. Her losses were smaller. Her plan hadn't changed. A year later, Olivia was ahead. James? He was still hesitant to re-enter the market. The difference wasn't luck. It was understanding their own risk tolerance. Now, what about you? Are you someone who can handle big swings in the market? Or do you lose sleep when your investments drop even a little? There are generally three types of risk tolerance. Conservative investors avoid volatility. They prefer safety. Bonds, savings, and stable stocks. They want their money to grow, but slowly and with less risk. Moderate investors want balance. They're okay with some ups and downs as long as they can still sleep at night. They often choose index funds, a mix of stocks and bonds, maybe even real estate. Aggressive investors chase growth. They take bold steps. Growth stocks, crypto, emerging markets. They know the risks, and they accept the roller coaster ride. But risk tolerance isn't just about personality. It's shaped by many things: your age, your goals, your income, your experience, and your emotions. For example, a young investor with no dependents might go aggressive, but someone nearing retirement? They might be more conservative, and that's okay. There's no right or wrong, just what's right for you. So, how do you figure it out? Start with a few simple questions. How would you feel if your portfolio dropped by 20%? Would you be tempted to sell? Would you wait? Or would you buy more? Be honest with yourself. You can also try risk assessment quizzes. Many investing platforms offer them for free. Or talk to a financial advisor. Sometimes just having a conversation can reveal more than you expect. Once you understand your risk tolerance, you can match it with the right strategy. Let's break it down. If you're conservative, you might hold more bonds, dividend stocks, and cash. Your portfolio focuses on stability and steady returns. If you're moderate, you might invest 60% in stocks, 30% in bonds, 10% in alternatives. You balance growth with protection. If you're aggressive, you may go 80% or more in stocks, with room for crypto or speculative assets. You're betting on long-term rewards. But no matter your style, one rule applies to everyone: diversify. Don't put all your money in one place. Spread your investments across different assets, industries, and markets. That way, when one falls, the others help you stay afloat. And remember, your risk tolerance can change. Life isn't static. Maybe you get a raise, or start a family, or decide to retire early. As your life shifts, your investments should too. So check in with yourself once a year, or when life changes big or small. Most importantly, stick to your plan. When markets go wild, emotions take over. Greed and fear can lead to bad decisions. But those who stay the course, those who follow a strategy that fits them, they're the ones who succeed long term. Don't follow the crowd. Don't chase trends. Don't copy someone else's plan. Build your own. Understand yourself. Invest with intention. And let your goals, not your fears, lead the way. Thank you for joining us today on Asset Zenith. If this story helped you reflect on your investing mindset, we'd love it if you gave this video a like, subscribed to the channel, and shared it with someone who might need it. Remember, success in investing doesn't come from timing the market. It comes from knowing yourself. So take a moment, understand your risk, and move forward with confidence. This is Asset Zenith, helping you grow smarter, invest wiser, and reach higher. Until next time, invest smart, live well, and keep climbing.